You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by our special guest today, the Twenties Trader, but I'll just call you James for the rest of this. So, James, do you want to just tell us how you first became interested in investing, and could you just briefly talk us through your investing career to date?
Sure. Thank you for having me on the show. No problem. So I started investing in 2013. My first share I ever bought was the Royal Mail IPO, which is quite interesting listening to some of your other investors coming on the show, Sam, how a lot of people kind of start off in the game with, IPOs of British companies. But that was my foray into investing when I was at college. So I was doing my A levels, and it's very business and economics focused. And I was learning about, what makes Unilever a special business, or the price elasticity demands of tobacco companies. I'm really just kind of getting my insights into all types of different businesses, and kind of that's where my interest really spiraled. So the opportunity came up to purchase the Royal Mail IPO, and I did. So I parted, I think, £700 at the time, and then sold it on pretty much straight after they IPO'd on the market. I think there was something like a £300-400 return there. So not bad for a quick transaction, but that really was my first kind of insight. And then from there, I just kind of started reading more and more about the markets, and slowly kind of easing myself in. I think my kind of investment journey changed a little bit when I went to university. So I studied economics, and I had a fantastic module, which was the economics of the financial crisis, done by a guy called Gary Abrahams. He was an ex-director of debt at UBS Bank during the financial crisis. So he kind of took us on this journey through fraud, the bubble of 07, 08, and much more, taking us through, the tulip bubble, the dot-com bubble, and really kind of instilling a very bearish view in us as a kind of a cohort of university students. And that really kind of, again, piqued my interest, but more into kind of reading books about, investing, from Buffett to Robert Shiller, and trying to kind of unpick why that crisis happened and where the markets were currently. So kind of extrapolating the two and sort of trying to find where we were at that time, which was probably 2014, 2015. So at university, I then kind of found the art of quality investing, and was introduced to a few people. So Terry Smith, Peter Lynch, other kind of quality managers, and just started to sort of see valuation in a bit of a different light, where I was previously looking at, very British value-based companies and not really achieving much of a good return. So looking at your Lloyds, your tobacco companies, and, those classic legacy businesses in the UK that your typical kind of commentators at the time were talking a lot about. And you had Neil Woodford, who was very popular at the time, talking a lot about equity valuations and how value businesses were, going to go through a step change and a re-rating. So kind of on from that, I was introduced to these more quality style managers and started kind of getting introduced to some of the companies that they hold, and really some of the companies that were moving the markets forward at that particular time. And kind of after dipping my toe in to those quality businesses, that's really where everything kind of started changing for me in terms of, investment success, understanding the market a bit more, and really kind of that's where things took off, and I started building my portfolio and, building from there, really. So I think that's probably a good summary of my investment journey to date.
So how did the actual 20s Trader come about, including the name, and also do you consider yourself to be more of a trader or an investor?
Yeah, it's a really good question. I think I'll answer your second question first, which is I'd answer that by saying I'm probably more of a blend of the two. I'd call myself a market opportunist. So I'm not really into trading anything across a super short time frame, day trading or anything like that. But if the opportunity lends itself for a good trade, then I'll probably be very interested in that. And I think it sort of comes from the idea that really in the UK, we've struggled to produce any real long-term compounders that you see in the US. So really, like, looking back at my investment history and what stocks people are involved in the UK, it's quite difficult to make a substantial return just by kind of being that patient long-term investor. And if you do want to be engaged in the UK markets, I think you probably have to consider a bit of a different approach. So an example that I'd kind of share, along those lines would be ASOS, for example. So in the last 10 years, ASOS has done a 300% rally, followed by a drop of 60% or more in 3 occasions in the last 10 years. So that's a great company. But, if you were taking the long-term approach to that business, you'd probably be pretty frustrated that you didn't execute a trade on one of the 300% swings. So that was kind of, an insight into why I think trading is probably an important tool to have. But really where it comes into play, kind of my thesis is to kind of keep as flexible as possible and not really let whether you're an investor or a trader dictate what you have to do. It's more about looking at the individual opportunity and saying, okay, if I'm into Microsoft or Alphabet, it probably makes a good, it probably makes a lot of sense to hold on to those companies for the long term. But if we're looking at some other opportunities that might equally give you a good return over a medium sort of period of less than a year, let's say, you've got to kind of look at those too. I think that's probably where I am at the moment. In terms of actually the name Twenties Trader, so I guess it kind of comes from my start of doing this service as a sort of newsletter provider, researcher at my website, which is the Twenties Trader. So really, that service was initiated from kind of me going through 8 years of learning about markets and wanting to kind of have a platform to discuss it, but not really kind of settling on exactly the right way to go about that and having the time to do it. So when the pandemic struck, I found myself with a lot of time on my hands, like everyone else, and decided to kind of have a go at creating this platform. And I thought that the Twenties Trader kind of embodies really what I wanted to talk about, but also kind of gives it an approachable name, something that people can kind of easily identify with. I'm in my 20s, I'm involved in the stock market. I didn't want to make it too serious. So I think that's really where that comes from.
What did make you decide to start the newsletter? And do you want to just talk a bit about what you actually cover in the newsletter?
Yeah, sure. So the start of my newsletter was really kind of initiated from a space where, I'm in my mid-20s. I've got a lot of friends who are just starting to kind of get interested in the markets, whether they've got their first job or they're saving some money to put down for a deposit for a house or something like that. So I was getting consistently asked for investment. Well, you'd probably call it advice. Of course, it's not advice. It's educational, informational purposes. But I had a constant kind of engagement with a lot of people that I knew around investing and getting involved in markets. So I kind of was sat there saying, well, why don't I, if I'm being asked all this information, why don't I kind of make some use of it and see if other people out there would benefit from the information? So I started writing, and really it was quite daunting at the start because you're kind of writing on companies, and you probably think that a lot of the writing is done by professional journalists or financial researchers. So just trying to kind of, I guess, acclimatize yourself to that, and also make sure that your writing is a good level of quality, that it can kind of stand the test of time and be a good reference point for people. So those are the kind of 2 kind of hurdles that I was dealing with. But starting the newsletter about a year ago now, I've got email subscribers in the hundreds and just under 100 sort of paid subscribers. I do it through a Patreon service. So the website's really looking at UK and a couple of US companies that I write kind of introductory investment research on a kind of quarterly basis whenever that company updates. So I cover popular companies such as Fevertree. I covered Bloomsbury, a publisher, a couple of days ago. So I kind of give a good insight into the history of the business model, and look at some of the financials. And really kind of a piece that I like to differentiate with my newsletter to a few that I've seen elsewhere, especially in the UK, is I don't use any secondary sort of research provider for financials or anything like that. It's all taken directly from the annual report. So I can kind of trust that information and share that with others. And so, that the website kind of encapsulates some free kind of introductory research. And then the patron service that I have covers my portfolio, which I have 2 portfolios that I list on there, and then weekly market analysis, in-depth newsletters that really take a peer group focus. So I was doing this on a monthly basis. It's now shifted to a quarterly basis where I do a big peer analysis of a sector that I like the look of at that given time. So I think the most recent peer group analysis I did was into the pet sector. So looking at companies like Zoetis, pet food companies like Freshpet, Trupanion, insurance companies, all this sort of stuff, to kind of really take a good comparison of that industry and look at each company's financials and their prospects. And then we take a kind of a dive into what the best opportunity at that given time might be. So I think that kind of style of writing where I'm looking at a peer group really kind of something that I don't see much of. I see lots of kind of deep dives into a specific company. But as an investor, I really like to kind of find investments by looking at a peer group and separating them out from peers. So that was really what my newsletter is all about.
So when you say like a peer group, you're talking like, for example, like you might take a look at the house builders and then see which one you like the best of the companies in that sector. Right, okay.
Exactly. So maybe not the house builders from a kind of a quality.
That was just a random example.
Yeah. So, maybe like a recent one that we did was the vision care industry. So looking at contact lens manufacturers, Carl Zeiss, which is an optical medical device company. So it's really kind of a specific quality industry, and then kind of extrapolating, all of the peer data.
Do you think that actually cataloging like your thoughts and your process and like having to like write down and knowing it's going out to other people has improved you as an investor at all?
Like, let's not be results orientated. That's the difficulty, because it's such a short space of time to kind of be results orientated. I've done it for just under a year. So, and who knows what the outcome financially is going to be in terms of investment performance. But in terms of actually going out there and being able to find these good companies and special situations and, really kind of understanding the wider market and industries, absolutely. So in terms of being able to kind of identify potential opportunities, yes. But I think, we won't know the kind of outcome financially for a long time yet.
I mean, it wasn't just financially as well, because it's just like, for example, like one thing I've noticed is like, since doing the podcast, it's like there's things where I'd say it, where I'd have thought it, and then when you're saying it and other people are going to listen, you think, oh, actually, am I actually 100% sure on that point? Or so I'd better go into. It's just like, I think looking back on how I was before doing the podcast, I think I don't know what the word is. There were just certain parts of like things that I was thinking in terms of how I was looking at the investments, where they were probably in hindsight a little bit sloppy. And because it's going out to like someone else, it's like, well, actually, I need to be 100% sure on every single point that I'm saying.
Yeah, no, I agree with you on that front. You can, without kind of having a reference point or someone that is looking at the work that you're doing, you can be slapdash, right?
Yeah, because obviously when it's for yourself, you don't actually need to go into as much detail, because you think you understand it, and then when you're actually putting it out and someone else is going to look, it's like, well, actually, I maybe don't understand that point as much as I'd assumed I did.
Yes, yeah, no, I agree with you there. I think the remit that I kind of like to get involved with, I guess, are understandable businesses. So that's an interesting one. I think maybe at some point I'll branch out into areas that maybe I'll exercise that muscle a bit more. So for instance, I don't really cover anything very technology focused. I think I've got a couple in there that I've covered, but I would never find myself writing about something like Palantir or, a company with, very complex software. If I was to write about that, that would take me a long, long time because I would have to kind of go very slowly and check all the facts. And so I think there would be that from a certain respect, but a lot of the companies that I cover are quite easily understandable. So you can kind of, there's less variation there probably.
So could you talk us through, talk a bit about your investment appraisal process and how you would look at approaching a new stock or potential investment?
Yeah, certainly. So there's a few different pieces to this puzzle, I guess. There's a kind of an overarching principle that I have, which is my kind of quality focus, for which I've got four main things that I look for. And that is growth is the first one. So is the company growing at an appropriate rate? So let's call it 10% really. Is anything above that I kind of deem appropriate to fit in the category, but not just, has it done 10% in a year or two? Hopefully it's got a long track record of growth, or you can see the way forward. I think if there's a couple of years that growth's kind of not been there, but then it's picking back up again, that's potentially something that I can consider. The second is operating margin. Since I've started focusing on stocks with good operating margins, so above 15%, you run into a lot less trouble. I just think, as far as peace of mind is involved, sticking to that one criteria will help you out a lot. So operating margin is something I look for. And then the two sort of more intangible factors, which are the moat. So if a company's got good growth, it's got a good operating margin, how's that company going to protect that business from other competitors? And you could potentially view that in a multitude of different ways: brands, patents, installed bases. And then lastly, management, which is probably the most difficult criteria to fulfill. We're trying to understand, how strong is management? What sort of decisions are they making, financially, but operationally too? And again, this is something that's very, very difficult to identify. And it's something that probably you have to keep up with because management changes, but also, what you think might be a very good manager, can turn around and do a massive acquisition, and your whole thesis changes. So those are probably my four kind of overarching principles. And then when I'm actually looking at new investments, I have two kind of pools. I'd say I have an existing universe that I've already kind of conceptualized 100 or so companies that I think kind of fit that criteria. And then also my research that I'm doing on a monthly basis, quarterly basis, is kind of feeding into that kind of universe that I have. So building up that kind of nice pool of companies that are potentially, good investments to look at.
What stage does valuation then come into it?
That's an interesting question. I think if we wind back maybe 5-6 years, valuation was the number one criteria for me, and that's where it's changed massively as I've kind of grown as an investor. The valuation really for me is kind of one of the last things now on the page. I mean, having kind of still had that upbringing in financial markets with, as I spoke about the module earlier that I took around kind of financial crisis and bubbles and things like that, I still kind of, I would say I probably automatically rule myself out of some areas of the market where valuation just doesn't make sense at all. But, if I like a franchise, I like a business for its prospects, I'm far more inclined to push the buy button regardless of, its PE per se.
What's the best book, or you can give more than one, books that you've read on the subject of investing, and how much do you read in general?
Yeah, so I probably read other materials more than I do books, just kind of out of preference. I probably prefer looking into specific company annual reports or reading fund manager notes. That's really where I kind of get most of my insights from. But in terms of books, I'll kind of list a few that I found very useful and insightful. So my all-time favorite is One Up on Wall Street by Peter Lynch. I think, just the way he takes you through his investment journey and his philosophies and what he looks for in investments is fantastic. And I think, have you read One Up on Wall Street, Sam?
I have. I think that's one of the best books someone can read as a beginner, actually. I think it's very good.
And I think it's something that I was just kind of contemplating quite recently was how, that process that he went through is so repeatable. And, for instance, we had a fantastic stock that you could have literally found very easily just following his process. And that was Lululemon, which to me is exactly the same as the shares that he was talking about the stockings that his wife was wearing. I forget what they're called. They're called like legs or something like that. But it was just so interesting that that's kind of repeated a process again and got on to be such a winning stock, exactly as his theory kind of states. So yeah, that's a favorite book of mine. And then kind of some of the classics. So Reminiscences of a Stock Operator, that's a good one. Stock Picking for Profit and The Naked Trader. They're two UK books that I really like. I don't know if you're into Robbie Burns.
I've not actually heard of him.
Oh, really? Okay. He's not on Twitter, but he's probably the most famous UK private investor. He's got his own website called The Naked Trader, and he's done 3 or 4 books that really kind of are about UK markets and spread betting and investing in the UK. So really insightful stuff there. And then Simon Thompson is from the Investors Chronicle. He's done a book called Stock Picking for Profit. Then I have a couple that are more economics related, but they still got quite a kind of hinge in the stock market. And that's The Subprime Solution by Robert Shiller, looking at the sort of 07, 08 crisis, but also looking at it from a property perspective and why equities are probably a better investment than property over the long term. And then The Black Swan by Nassim Taleb. That's a good one if you are interested in the human psyche of markets and thought processes. Very, very insightful there. And lastly, I've got one that's a business related book, which is one of my favorites, which is Going Down Tobacco Road by a guy named Gene Hoots, who was a employee at RJ Reynolds over a sort of 20-year period. I think he was an accountant for them. So he kind of chronicles their rise. Pretty much one of the most successful companies ever. So it's a good book too.
Have you read any of Taleb's other books?
Animal Spirits, is that his other book?
I don't know that one. So I know there's Black Swan. Is it Full by Randomness?
That's the one. Yeah.
Yeah. Anti-Fragile. So Anti-Fragile, it's on my list, but I've not actually read it yet. I mean, he's got quite a lot actually. Yeah.
Yeah. No, I haven't covered anything else really than the Black Swan. I think it's quite a different way of thinking. But again, as I've kind of moved on, from over time, you sort of find that the bearish thinking isn't essentially a profitable strategy. So it's important to kind of consider things, but you don't want to get too bearish when you're in a bull market, right?
Yeah, I think his way of just the way he thinks about certain things, I think is really, really useful to read. But when he describes his own portfolio and how he runs that, I agree. Like it's certainly not something I'd want to try and replicate. And I'd like to be completely honest. I would question I would be interested to see how successful the portfolio has actually been for him over the long term, or whether he just makes all his money from selling his books.
Probably the latter, right?
yeah. But they are really good, and he does have some really, really interesting thought process. But it's definitely not how I'd want to run a portfolio. But a lot of the best books are actually like that. I find it's the ones where it's a different style to your own. So, what are the best resources that you use for investing? And these can be free or paid.
Yeah, absolutely. So I don't really subscribe to too many services other than the FT. So I'm a big reader of the FT, like to look in all of their columns. There's a free one on the FT called Alphaville. That's fantastic. They've got some great writers on there, a guy called Jamie Powell and another guy called Bryce Elder. And they used to do a FT Alphaville chat that would give you all of the broker notes at various points in the day. Which they disbanded, but that'd be very nice to get back. But yeah, so the FT is kind of like one of my main go-to resources. In the UK, we've got an RNS platform, which is basically gives you all the regulatory announcements from companies. That's called InvestEgate. So you can kind of pick up what AIM companies, FTSE 350 companies are reporting. I'm a big consumer of fund manager notes. So I read Lindsell Train, Ennismore, which is a UK hedge fund. They do some fantastic small cap notes every month. They publish one. Poland Capital, which is a US hedge fund. They've got fantastic writers that really focus on small and mid cap American and international companies, but they've got some really good sort of thought pieces and perspectives there. Bally Gifford. So they have a trust magazine, which is a quarterly magazine, which is pretty much essential reading. If you're an investor, you can get a nice glossy magazine shipped to your door. So well worth going on their website and taking a look at that. Also Miller Value, which is a US value-based hedge fund. Bill Miller, he writes various notes, I think, on a quarterly basis. And then I've got down here Crossing Wall Street, which is a guy named Eddie Elfenbein. He's actually on Twitter. I think he's got something like 60,000 followers, so he's quite popular. But he runs an ETF called I think it's the CWS ETF, which basically focuses on 20 to 25 companies that he holds, and he boots 5 companies out a year and puts 5 companies back in. So, you've got some of these companies that he's held for 10, 13 years, and they're very kind of high quality businesses that he provides continue updates on. So that's a really good asset to have. And obviously podcasts. So I listen to a couple, a lot more in the US. Obviously I listen to The Investor Way, but in the US I listen to The Compound and Friends, which is Josh Brown. And Bloomberg's got a couple of good podcasts, such as Odd Lots and Masters in Business with Barry Ritholtz. That's really good from a sort of a business perspective too. And I think that's it probably in terms of resources. What podcast do you listen to, Sam?
So for podcasts, I mean, I do actually listen to most of the Motley Fool ones. I think they're quite, even though a lot of like the news ones, you've already seen it on Twitter. It's quite interesting to just hear their thoughts. I like Rule Breaker Investing with David Gardner. I just think he's very, very good. There's I can't remember what it's. It might be like the Quality Shares podcast or something like that. The new one that Phil Oakley and John Human have just launched, which is UK focused. I'm enjoying that. It's basically the same podcast they used to do at the Investors Chronicle. So that's back when they were working there. That's a good one. I really like Value After Hours. I think that's really, really, I get a lot from that. Bill Brewster's got a podcast where he does like long form interviews, and he gets, I mean, with that one, I actually pick and choose the episodes because there's somewhere I read about it and it's more of like a business thing than an investing one. But when you pick and choose your episodes, he's got some really fantastic interviews on there. I'm just trying to think if there's any others. I probably am forgetting some. But yeah, those are the main podcasts that I listen to.
Yeah, I used to listen to I think it was the Alpha podcast.
That was it. Yeah, that's what it was.
A couple of months ago with Phil Oakley. So
no, the new one's good. I'm enjoying it. I think it's definitely, if you're looking for another UK focused podcast, I think that's probably the one I'd recommend. Who's the
kind of main? Would you call them a podcaster or a speaker?
It's what on that one?
Yeah.
It's Phil Oakley and John Human. So I don't know if like you listen to the Alpha podcast that much, but they were the guys that so John Human used to host it every week, and he'd usually get Phil Oakley was the guy who'd come on and talk about the stocks a lot because they covered other topics. But they both left the Investors Chronicle a few months ago, and they've gone and started their own website called invest-ability.co.uk, I think, and they've started a podcast as well. But I'd say the podcast and the website are probably both worth checking out because they are both fantastic. Phil Oakley, he's actually written a book as well, How to Pick Quality Shares, which I've not actually got around to reading yet, but it is on my list. I think John might possibly have read it, but yeah, I haven't read it yet. So who do you look up to as an investor?
I think really, the greats that, everyone looks up to being your Buffetts, your Peter Lynch, your Terry Smith, the Bally Gifford guys, so Tom Slater and James Anderson, and they've done some fantastic things. I don't know how much you know about Ennismore, the fund manager in the UK. Have you heard of them before?
No, I haven't.
So they're a small fund that, they take some really, really incredible bets on various companies, and they managed to snuff out Wirecard pretty quickly. And they held a short against Wirecard for a long, long time, which was tumultuous for them, as I'm sure it would be, but in the end they came true, and they picked out quite a few companies in the past where they get suspicious of, and they do turn out to be frauds. So really interesting guys, and they kind of the work that they do and kind of share it's really worth looking at, especially if you're interested in that kind of small mid-cap European and UK space. They're fantastic in that area. Some UK private investors I also look up to. So I've said about Robbie Burns, Simon Thompson, and Bill Oakley, as we've discussed already. So they're probably three as well in the UK. So yeah, I think that's probably my kind of main list. What about yourself?
Oh, it'd probably be all the big hitters. Probably it'd be sort of your Mungers, your Buffetts, Manish Prabrai, Terry Smith, Nick Train. Just trying to think.
What do you think about the kind of dispersion of Smith and Train? Do you think that gap will close, or do you think that Nick needs to kind of change his style as such to kind of close that gap?
I don't know, to be honest. I don't actually. So I read the Terry Smith book recently. I don't actually follow either of them particularly closely day to day. So I'll read. I know Terry Smith's doing really well. With Nick Train, it's more like if I come across him and like if he's got something to say about, if I see he's done an interview or something, I will just go and listen to it. I don't actually monitor his performance. I just like listening to what he has to say. So I probably aren't very well placed to actually comment on the dispersion, just because I don't actually like actively follow either of their funds. I just like listening to what they have to say.
Yeah, no, that's interesting. I think obviously, as you said, Terry Smith's been doing so well as a fund manager that it kind of you end up moving so far away from the pack. But Nick Train's kind of definitely struggled over the last year or two. I think his fund is either flat or slightly negative for the year, in a year that a lot of the competition have done pretty well. And I think if you read his notes over the last 6 months, you'll see a lot of kind of how can you call it, a lot of mild apologetic sort of comments as to kind of the performance and the lack of technology sort of based stocks in his portfolio, and the fact that he'd rather hang on to his companies that kind of can leverage technological change to kind of progress than the technology companies themselves. So he uses Disney as an example, kind of leveraging streaming in comparison to, say, owning the technology itself. So it's quite an interesting sort of paradigm there.
Yeah, I mean, having like caveated it by saying like I don't actually follow his performance that closely, I would say that over the long, I mean, a year or two is not that long anyway. I would say over the long term, I would probably be quite confident backing Nick Train to do well. So
yeah, no,
I wouldn't be losing sleep for him.
Yeah, no, I agree. I think almost it's one of those things that people kind of, you don't want to measure your performance too closely if that kind of specific fund gives you access to a group of companies or an asset or a style that kind of diversifies you away from a lot of the technology names that are in other funds. It's got a place, doesn't it?
I mean, one of the guys I follow quite closely, it's a guy called Tobias Carlisle. He's the guy that hosts the Value After Hours podcast, and he's a deep value manager over in the US. And since about 2010, value's just been doing horrendous. So he's basically had a decade of underperformance, and he completely owns it but he still thinks that over the long term these markets have proven to be cyclical, and value will have its day in the sun again. And 10 years in, he's still sticking to his guns. But I think just because we could easily, it's not inconceivable, especially with some of the values right now, we could go through a period of 10 years where a lot of the growth stocks now don't move, and they're just growing into their valuations. Because if you've got a company that's at 40, 50 times sales, the business could perform very well, and the price might not actually change. So I think the actual performance of like whatever strategy they're using doesn't necessarily reflect on whether they're worth listening to. Because I mean, Tobias Carlisle, for example, he could continue to underperform for the next 10 years. I'd still quite happily listen to his podcast every week because you can just tell he knows his stuff. But yeah, so which Twitter accounts would you recommend following the most?
So I'm actually quite new to Twitter. So I joined Twitter probably 8 months ago or so. And to be honest, I probably wouldn't necessarily be on Twitter if it wasn't for the purpose of kind of sharing what I'm doing and kind of growing viewership for my kind of website and service. So I think my kind of initial experiences with Twitter have been a bit kind of negative, shall we say, in some of the kind of stuff that I follow and see. And I think I'm a little bit skeptical of some of the stuff that I see on there. So I could probably benefit from following, a pruned list of good accounts. So I'm probably better off listening than dictating here. But there are a couple that I do follow, and that was really kind of accounts that give me access to primary information. So Librarian Capital, I like, because he just kind of summarizes results in a kind of very simple way. There's a guy covering Europe, and I don't think he's that well known. His name is Paul, but his Twitter handle is Stocks Market, STOXX Market. And he does fantastic kind of summaries of quality European companies. And then in the UK, we've got a couple that I follow, which is a guy called Rhomboid, a lady called Aston Girl, and then Quality Share Surfer, and a couple others there. So, but yeah, as I said, I'm not really an expert on Twitter or follow lists yet. So yeah, be interested to hear from you.
I'd say I'd actually recommend probably, like, if you just go through the list of people we've had on the show, if you just find them on Twitter, I'd recommend just going down their follow list and my own as well. And just what I find is, you just, any that looks quite good, you can follow them. And then, if after a couple of weeks you don't really like what they say, and it's very easy to just unfollow them. So that's the way I do it periodically. I just go down someone else's list who, like, I know that I like what they have to say and the way they think. And then I'll just have to see if there's any more that I haven't come across yet.
Do you think Twitter's a useful service for you as an investor?
I think it's incredibly useful. I get a lot from it, but it's probably taken me a long time to hone my follow list. And there's even some people who have, if you'd asked me a year ago, I would have said, well, you've got to follow this person, really. And then now my views have changed a bit, or they've started, and I actually wouldn't necessarily, and I've unfollowed them since, and it does change. But no, I think if you can get the follow list right, it's a really, really useful tool. But if you don't get it right, it can be quite frustrating and not a very good place to be. It's difficult in that respect, because you do have to really hone your follow list. But I think it is worth putting the time in, to be honest.
Yeah, there's no regulator, is there? So you can just get such a crazy bunch of people talking about, a load of rubbish. So I've kind of witnessed a few things. The rise and fall of guy, what's his name, Puru.
Yeah, I used to really like Puru, and he was one where I would have put him in my top 5 a year ago, and now he's like, he just sort of he seems to just lose the plot a little bit, to be honest. That's probably the most
you had people tracking his trades as such, and sort of seeing that he'd announced that he's kind of bought something, and then wouldn't it would crash, and then he's not holding it. And
and there's one time where it was going into earnings. He started, he did this bullish tweet on a company. I can't remember the company now. And he put at the end of the tweet, "I'm long." 1 hour later, he did a tweet saying he'd sold, and it's like, how long's an hour? It's but yeah, and then there's a few, like, I think what did it for me with Puru, because his track record is very good. I know some people do like to try and analyze the tweets and stuff, and I do actually believe that he has a very, very good track record. I think he's, in the last few years, he's up about 400% or something silly, which, because he is basically in the highest growth companies that perform very well. I do find it believable. What it was for me was when he started posting about Bitcoin, because he quite clearly did not understand it. And I've got no issue with people like commenting on Bitcoin and stuff, but if I get a sense that someone's talking about something and it comes across, I think, with Bitcoin, you can tell when someone's just attacking it and they don't know their stuff. And it was very, very obvious that he just didn't understand it and hadn't even put the time in trying to understand it. And I just felt like reading his tweets were just wasting my time at that point. So that was what led to me unfollowing him.
So he was taking a negative sort of stance on Bitcoin.
Yeah. And it was a lot of it was like the same arguments that, I've heard a lot of the arguments against Bitcoin before, and he wasn't offering any new takes. And there are a lot of arguments that people can make against Bitcoin, but they're actually quite uninformed arguments. And if someone had taken the time to understand it, they wouldn't be making the points they were making. There's possibly different points they would be making, but you can, I think, if you spend enough time learning about Bitcoin, you can very quickly get a sense of whether someone else who's talking about it, whether they're criticizing it or praising it, knows what they're actually talking about. And with him, it was just painfully obvious that he didn't. And the problem is, he was tweeting about it a lot. So like it was just annoying me. So I followed him. But I'd
Are
still have him on the
you
show if he's listening.
Yeah, well, he's got quite a large following. So it's probably net positive for you. Even
Oh
if
yeah,
it's,
definitely have him on.
Yeah.
But
Cool. So are you a Bitcoin holder yourself?
I was until recently. So I actually sold a couple
Okay.
of months ago. It wasn't anything to do with valuation. It was just that I might need the money personally in probably the next 12 months. And it was a case of I could sell some stocks or I could sell my Bitcoin. And the Bitcoin was the amount of money I might need. It's just one of the things, isn't it? If you know you're going to need it in your personal life. I mean, Bitcoin at the time, it was about 46K that I sold it. And I just thought, I could have held on and, maybe I could have sold it at 100K in a few months. But equally, if I found myself selling it at 30K and then I had to go and like raid my stock portfolio as well for the cash, I would have been kicking myself. So that's why I sold it. It wasn't anything to do with valuation, but I still really like it. I do back it. And I think I expect I'll be buy it again in the future, even if it is at a higher price. I almost view it as like an alternative to like saving in a bank account. I know it's silly because it's like very, very volatile, but I think once I'm in a position where like I might not need the money in the next 12 months, what I'll probably do is like I'll just go back to having a monthly amount where I just put it into Bitcoin and almost use that as like my way of saving. I know I've got like the stocks as well, but yeah, that's sort of what I use it for. So yeah, I don't have any Bitcoin, but that's not actually a reflection of my opinion on it.
When you talk about valuation of Bitcoin, is there any kind of concept or mechanism you're using it to value against, or is it just the arbitrary price?
Well, it's not so much the price, it'd be the market cap. It's kind of like a stock in that respect. Yeah. But I just think for the market cap, it depends on what you think it's going to be used for. But for me, the digital gold argument holds a lot of weight. I think it's a unique asset. I think any cryptocurrency that's come along since, I don't think, to me, it just doesn't have the same value Bitcoin has. It doesn't have the same reputation. It doesn't have the same level of security in the network. And for me, the best argument is the digital gold argument. And I think if you look at the digital gold argument, I think Bitcoin's got a market cap at the minute of, I don't know, like maybe 1.5 trillion. I'm just making up a number. Gold's about 8 trillion. And then, so it's, again, is that right? Yeah. In fact, I think it's something like that. Gold's about 8 to 10 trillion, I think. So it's something like at the minute, I think Bitcoin's market cap's about 10% the size of gold's. I think it could be a lot higher based on that. I mean, it's still quite wishy-washy and it is very, very subjective. There's no reason, because I mean, it could function as a store of value, whether the market cap's 1 trillion or 100 trillion, it would still perform the same function, which is where it's quite difficult valuing it. But I just think a lot of it's supply and demand. And if you have enough people that are using it as store of value, you almost end up with a lot of the supply that's taken off the market. And, where you've got that 1 trillion market cap or 1.5 trillion, I mean, how many of those Bitcoins have been lost forever? How many of them are in wallets that people can no longer access? So then if you look at this, the market cap of what's actually available, you get to a smaller and smaller amount. And I think I just look at it and think, well, that this could be a lot bigger. And I think especially when you look at what's going on in terms of like central banks all around the world just devaluing their currencies as quickly as possible, I think having like a global way that everyone can opt out of that, for me, Bitcoin seems the solution. So that's how I think about it, but it is difficult.
That's interesting. I'd be interested to hear your thoughts on what, if anything, do you think would be the downfall of Bitcoin?
I've seen some stuff where, in theory, a quantum computer would be able to overpower the blockchain and start rewriting it. And then at that point, the security's gone and you can't trust it. Obviously, I don't know how far away we are from quantum computing. And if we can have quantum computing, why couldn't you have quantum resistance? So that could be like 30 years in the future anyway. In terms of the other stuff, I don't really worry about like governments banning it and stuff. I think people would continue to. I struggle to see a scenario where like governments around the world all ban it. I don't necessarily think there's even a reason to ban it either. Yeah.
Here's a question. Once every single Bitcoin is mined, does the carbon intensity of Bitcoin then, plummet off a cliff?
Well, it's not to do with how many. Well, I mean, the last Bitcoin won't be mined until the year, I think it's about 2140. So we won't be around to find out. But what will happen is, or what should happen is, the block reward gets smaller and smaller over that time. So the amount of new Bitcoins being released every 10 minutes. And then what will happen is, in theory, if it works, there'll just be a transaction fee instead. And the transaction fee would be enough that people still have an incentive to mine it. But the amount of carbon it's emitting, it's not actually anything to do with the Bitcoin protocol itself. It's just what happens when lots of people are plugging their computing power into trying to mine it. So if you're in a position where in 10 years' time, twice as much computing power is going into trying to mine it, all other things being equal, it's going to be emitting twice as much carbon, unless they're using like renewable sources to do the mining. So if you've got like a rig that's being powered by solar or something, then that would, but yeah, there's not, I don't see it having a huge impact, because I just think as long as Bitcoin itself is valuable, people are going to be trying to mine it, even if it's unsuccessful. And even though it is really, really competitive to mine it now and really difficult, I think if people have like some spare computing power, they do just plug it in. And well, it's not unfortunate, because it is also, it is what gives the network security. But in theory, there's no reason why all the computing power that's going into mining it couldn't be powered by renewable resources. It's kind of like, it's like anything else in that respect.
Interesting.
So what do you know now that you wish you knew when you started investing, and what advice would you give to yourself when you were just starting out?
Yeah, so I think good question. Hindsight's a wonderful thing. So I think, part of investing is kind of learning the lessons that I guess you don't learn unless you kind of make some mistakes and kind of learn from them as you go. So I think if I kind of gave myself all of these tips when I started, you'd never know what you'd kind of turn out, whether it be the same now or not. So, but I think the main kind of things that I'd focus on for other investors would be basically, number one, don't buy, junk companies. Terry Smith's got a great kind of catchphrase there, which is don't expect a good return from a bad asset. So, very, very interested in risk adjusted return. So I don't want to be taking lots of risk and be, worried about potential blow up. So, just avoiding companies with low profit margins, in highly cyclical industries or industries in secular decline. These are the sorts of things that I really want to avoid, and have kind of helped me out as I've kind of journeyed as an investor. I'd probably like to kind of understand a bit more about valuation and kind of lessons on valuation. So that ties in a bit to the kind of the bad companies piece. But, just because something is cheap on paper doesn't mean it's necessarily going to be a good investment. So just trying to understand that. And then on the flip side of valuation, just because something looks very expensive, again, it's not, necessarily something that's going to be costly to you. And I think, in that really is a message there of kind of don't be afraid to buy something excellent. If it's a business that's changing the world or changing its specific industry, or you've got that feeling that, this business really is a category killer, and it's going to be a big thing, I think you can kind of forgo some of the valuation and, worrying about the cost, especially if you're starting out. If you're a young investor, you've got, a massive career ahead of you, that if you like a company a lot, taking a small position, even if the valuation is quite high, prevents you from losing out on that company's growth. And it also gives you the opportunity that, if the valuation does come back a bit, you can add some more. So I think that would be kind of the main piece. And then another piece around really kind of getting to the primary source of information. And that's what I've really learned through this process behind Twenties Trader and doing my research, that, you can read as many secondary sources, articles or, pieces of information about a company as you want. But unless you're reading the annual report, looking at investor presentations, listening to the earnings calls, which I can give a quick plug. There's an earnings call app that's fantastic. You don't even have to go on the internet and look at a company's earnings calls anymore. You can just go on your phone, type in earnings call, download the app, and it's got hundreds of companies that you can, fast forward the speed or listen at your leisure. So that's a really good tool that I use as well. So getting to that primary source of information for me has been, really important to kind of understand the company and its trajectory without having, someone's lens or bias potentially affecting, your thoughts on the company.
What are the biggest mistakes you've made in investing?
I think probably you can kind of split that question up into two different kind of themes. And, the first being stock specific mistakes. So I've kind of covered a bit about buying bad companies, but early on in my investing career, I was doing that to a higher extent. So bought some legacy businesses such as Lloyd's and cyclical companies, small mining companies that never work out as well as the current shareholders are expecting. Some get through the net, but many falter. And then I bought some UK support services businesses, and these just had very poor margins. They were cheap, a lot of cash flow, but you can run into a lot of trouble there too. So that's kind of a stock specific area. Another stock specific area I've made a mistake in the past was looking at companies and purchasing companies that I've got a lack of visibility into their revenue stream. And so that really is a key area that I think about in my approach now, is if I'm having to wait from, quarter to quarter, or, in the UK, we don't do quarterly updates. We do, interim reports, trading updates, and, year-end results. If I've got to wait for 6 months without seeing any visibility of how this company is performing, that's an issue for me. And I can't really get a good insight, can't really get an edge, and you're kind of just waiting to hear that update, whether it's good or bad. So that for me was a real area that I try to find companies now that I can kind of get a good oversight. And I can give you an example. Into a mistake there was buying a company called Network International. Have you heard of Network International?
I've never heard of it, no.
So it's a Middle East and North African payments company, quite similar to a company that you've sort of mentioned on the show before, Airtel Africa. This company, I think, is more in the space of physical card and merchant acquiring and things like that, rather than mobile payments. But it's actually got a partnership with MasterCard sort of throughout the region to grow its business alongside sort of MasterCard in North Africa and the Middle East. I think MasterCard took a 10% equity of the business when Network International IPO'd on the stock exchange in London a couple of years ago. So I looked at that, and I wanted some exposure to the area. Payments was very hot. The company's financials looked okay, but there was that massive blind spot of visibility into Network International's revenues. I have no idea 1 month to the next how these revenues, earnings flow, cash flow is going to change. All I have to do is wait for this report, because it's something that you just can't get oversight of. And so I guess the kind of results of that are twofold. One, you don't know, firstly, is the company reporting exactly what you think it is? We've seen other companies in similar geographies and areas. There was a company called NMC Healthcare, which was a FTSE 100 darling, was a medical sort of a hospital services provider in the Arab Emirates. It was doing great numbers, and that turned out to be a fraud. Restated earnings, and the shares crashed, and I'm not sure whether it's on the FTSE 100 anymore. So we've had kind of those situations before. So it could turn out to be one of those. But two, just because there's a lack of visibility of revenues, you then are in a situation where if someone puts out a short report or a bearish view, you've got nothing to back that up. You really you're holding onto your hat as such, because you've not got an edge to give you extra conviction. So that's really an area that I kind of made a mistake in and kind of learned from. So I'm happy to have that discussion whether you think that's relevant to your investment in Airtel. But yeah.
I mean, to be honest, it depends. Like for me, like when you're actually like looking in, I mean, Airtel, I think the reports, the annual reports have got, for me, a level of information I'm happy with. I've read a few other articles about like the general competitive environment in Africa. For me, a lot of it, I know it's like quite a wishy-washy thing, but it's like when I'm reading the reports and stuff, I need to be able to like actually visualize the business and what it's doing. And with Airtel, I think I can do that. But as an example, like we looked at, this is months ago now, we looked at a company called StoneCo, which is kind of like trying to be like the PayPal of Latin America.
Yeah, I know them.
And I really struggled looking through like the investor presentations and the annual reports. I struggled to just picture how the business works. I don't know why. I just couldn't. It's always harder when it's in a foreign country and it's not like some big US business like Facebook. And it's like, because you don't ever see it in action, and you probably never will. But like, for example, like with Stonecoat, I just couldn't like get it in my head how the business all works and how it sort of clicked together. And I don't know why. I just couldn't understand it. Whereas with Airtel, I've just not had that issue. I think it's been fairly easy to understand. And I guess as well, like the normal telecoms business for me is attractive enough on its own because it's so cheap and the growth is still so high. And I guess with the Airtel Money side, that potential is obviously huge. How they're executing like on a day to day, I just don't know. But I mean, it's very clearly coming through in the numbers. I mean, when they're doing 50 odd billion of transaction volume over there, and that's up like 50% year over year. It's not something I'm particularly worried about. And then with the actual telecom side, obviously they're on like, well, it's mainly pay as you go. So I guess that does make it a bit harder to track how it's going to do month to month. But I think with phone providers, that there is obviously going to be like quite a large element of cyclicality as long as they're able to maintain the customers. So yeah, that's sort of, I don't think I've really answered the question, but that is how I think about it.
No, it's what everyone's comfortable in, isn't it? And I think that there are probably some similar companies in my portfolio that I'm kind of, you're happy to take the kind of, on the balance of probability, you're quite happy to take the risk and sort of sit back. But there are just a few that, in the past, I think it's mainly, when there's trouble, that's where you really sort of start to look at it and go, was I a little bit kind of far removed from it? And I think you're lucky if that doesn't happen. But
yeah, I mean,
in the case of Network International, there was a short report going around, and I didn't have it, couldn't see it, and I know nothing. So you're sat there, completely unable to really come to a decision, and then you end up panic selling and taking a loss, and then thinking, really, I had no any other company that you can go and see, touch, feel, or just understand, whether they're doing business.
Yeah.
That is that sort of thing that for me, I like to have that clarity and that conviction in.
Yeah. I mean, one thing I do try and do is I try and like search for the company on Twitter occasionally and see how like people who are actually like, because you will get
That's
people in Africa who are actually using it. I mean, that's obviously like a very restricted data set, and you can, it's useful, but you certainly can't rely on it. But that's the only real way I can try and get a sense of it. But even then, with any business, you usually just get people trying to like complain or something like that. So again, you don't see all sides of it. What are your thoughts on current valuations in the US?
Yeah, it's the most important question, isn't it? It's interesting. I think, there's no doubt that it's frothy. There's, there are areas of the market that are in very, very stretched valuation territory, but you've just got some companies that just continue to surge higher, and to a certain extent, you almost get tired of talking about a bubble, or you get tired of just talking about valuations over such a long time when they just keep seem to rising. So, one thing I've read recently in a note from Poland Capital, they map out on a graph 40 years of interest rates, and basically it's slightly up and down, but it's a diagonal curve downwards. And now we're looking at, I think, correct me if I'm wrong, I think the 10-year yield on the Treasury is 1.5 or 1.15, something like that. So you're looking at yields on bonds that are uninvestable. If you're looking at an earnings ratio as an investor in a bond, you're looking at a ratio of like 65, 70 times that you're willing to pay for a return there. So what does that say? It either says investors are so scared that they're willing to pay, put billions of dollars into bonds because they're worried about the market, or, they're obviously expecting changes. So I think, looking at that interest rate decline over a period of 40 years, that's exactly why we are where we are, but we don't know what's yet to come. So I think, personally, I will be staying out of the super high, potentially bubble areas of the market. I own a couple of very highly valued sort of software companies, but I've come to that kind of space and understand it for myself more as an insurance policy. If these companies go on to be the next big thing, and they go on to do the sorts of growth that investors are currently expecting, I want to make sure I'm prepared to own a bit of that. But I don't personally think I can be kind of engaging in areas of the market that are trading at that kind of extreme valuation. So, but despite that, there are areas of value. So the guy I was speaking about earlier, a guy called Eddie Elfenbein from Crossing Wall Street, he's bringing up stocks all the time that are in those sorts of good value areas of the market. If it's not super trendy, you can find some really good, good US growth stocks that are trading at decent valuations. So yeah, it's really where you look, I think. What's your opinion on it?
I think there's definitely a lot of froth, but I'd be inclined to agree with you. I think there is still value out there. I think you certainly got to look hard for it, but it's definitely there. I mean, even stuff like, for example, like I'd say Disney at the minute, I think when you factor in what Disney Plus could be, I think that's fairly reasonable. Some of the growthier companies, like for example, I've got Peloton, which I think, compared to, again, some of the really, if you compare it to a Snowflake or something, I think the valuation on that's pretty reasonable if it can deliver what I think it can deliver in terms of the subscriber numbers. All the stocks in my portfolio that you'd go down the list and say, well, that's a growth stock, I can quite comfortably say, well, here's why I think like at the current valuation it's quite cheap. And there's some of those businesses where if they were trading at some of the sales multiples that some of the other ones are, they just wouldn't be in my portfolio. I know it's always difficult deciding when to sell and stuff, but like as an example, like Etsy's a business I really like, and I don't know the exact valuation at the minute. I'm going to guess and say it's 20 times sales. If it was 60 or 80 times sales, like some of these other businesses, would I be holding on to it? Probably not. I don't know how big I think it, it's difficult to say, well, what's almost like, what's a terminal value? How big do I think this business can get? And with Etsy, it's about a $30 billion business at the minute. I think with the growth, it can still deliver. I think it's such a fantastic business. I love using the platform. I look at it and I mean, this is obviously a very, very basic version, but I just think at 30 billion, I think it can be worth more than 30 billion, definitely. If it was worth 100,
it can 10x from here.
Yeah.
Really.
If it's 100, 200 billion now and the sales are exactly the same, it's like, well, maybe it can get to a point where it justifies that valuation, but it's really got to deliver. And then how many of those returns have been pulled forward? Because I think, for example, if you're paying 60 or 80 times sales for a business, if you want to beat the market over the next 20 years, that business really has to deliver growth. And I think that's what people don't get. It's like, well, maybe the business can grow enough to justify the current valuation, but you're looking to get a market beating return from it, and you might not get that from the current valuation.
Yeah.
It's kind of like Snowflake, where that's trading at like 100 times sales or something ridiculous. And it's like, how, you can think it's the best business in the world, but 100 times sales, how much of that growth is already priced in? Because I'd argue a lot of it is.
Unless it's growing at, I don't even know what Snowflake's growing at.
But then even I think it's actually like, it's probably about 100% a year. But how many years does it need to do that? It needs to do it multiple years in a row, and that growth is going to slow as it gets bigger. And it's a lot of it. It's more to do with the risk, isn't it? Because I guess like at 100 times sales, it could beat the market, but it's much higher risk at that point because it needs to really deliver on the growth to beat, for the stock to beat the market. Because I guess when you look at Tesla at the minute, like I know people say it's an energy company and all this, but like how many cars and how many solar roofs do they have to sell to justify $1 trillion valuation? And are they going to get there?
Apparently only 4 billion to add 100 billion to its market cap.
Well, exactly. Yeah. So it's like, even if they're at a point, let's say it's never going to be a cheap stock.
Yeah.
Well, certainly not for a long time. Let's say they get to a point, and like I said, I don't know what sales are actually at the minute, but let's say they get to a point where the earnings are 50 billion a year, which is an insane number. I mean, at the current valuation, that would be a PE of 20, which is quite pricey. If it's not got much, say that's the maximum. I mean, earnings of 50 billion, when you look at the size of the business now, that is insane growth. And then for that to be at a PE of 20 at the current valuation, it's like, well, again, how do you where do those future, if you're buying it now at $1 trillion valuation, where do you think the market beating returns are coming from? And I struggle with, like, I'd say Tesla for me, as good a business as it is, as impressive as it is, as much as they could go on and dominate like people think they can, I just, again, like, I think I just don't see how most of that isn't priced in. I think if you were buying it today, it is extremely high risk. Because I mean, if you say the market's going to go up, let's say it's going to go up 10% a year for the next 10 years, is Tesla going to beat that from a starting point of $1 trillion? Because I mean, what's that going to be at the end? You're then talking, in 10 years for you to beat the market, you probably need it to be at like 2.5, 3 trillion. And again, they've got to sell a lot of cars to justify that. So yeah, it's a bit of a rant, but that's my answer.
Yeah, no, I agree with you on Tesla. I think that's one of the, such an interesting space of the market. But I think going back to what I said earlier a bit, I think, you've got some of these emerging companies like Tesla, 3-4 years ago. This is the lesson. I think you've got to own a bit of some of these companies as an insurance policy. I think that we can all laugh at Tesla's valuation now, but in essence, we're on the wrong side of the argument.
Well, I mean, when we did the Flosser interview, Tesla was an 85x for him, and I thought the valuation was insane at that point. Yeah. He's sitting on 120x now, so Flosser was obviously right. But
exactly. So yeah, I mean, they've done incredibly well, but and then again, there's still the argument that if you look at the amount of money Google pays Apple to be the leading search engine on their platform, I'm probably going to misquote it here, but it's something in the 10 billion plus, realm that, that sort of agreement can change, a stock's, valuation or just kind of the conceptualization of its value. Once you've installed such an amazing technology and hardware that everyone uses, there's then these kind of new ways that you can extract value from it. And I think, we'll see whether $1 trillion stands up to be the right valuation for it. But I think it's certainly, it's in Tesla's intrinsic value is a lot higher than I probably deem it to be.
Well, I would say I actually looked at Ford the other day, and Ford needs to 16x to get to Tesla's market cap.
Yeah, that's ridiculous.
That's unbelievable. I couldn't actually fathom that. But anyway, so what are your thoughts on current valuations in the UK?
Yeah, again, interesting situation. I kind of find the UK a bit more perplexing because of a few reasons. People say it's cheap a lot. You'll hear from every pundit that the UK is cheap. But for me, I look at UK stocks, and if you're a good, seriously good business operating in the UK, you trade at a pretty significant premium, I think. Some of the small caps in the UK that, investors know and love, or, whether you're looking at the FTSE 100, if you're like a Halma or a Croda or, Spirax Sarco, these sorts of companies that are like the equivalents in the US where they can just churn out consecutive years of, earnings growth. I think they are, pretty well valued. There's certainly no Halma shareholder sat there saying the multiple should be double. But then there are, again, kind of pockets of, strange valuation theory that you've got going on, especially in the smaller tech growth business area. I think that's a real area that the UK is undervalued, just because there are no big tech investors in the UK. So stocks like Darktrace, for instance, people say that that's overvalued. But if you look at what an equivalent business in the US that's doing Darktrace's sort of growth in the sector, a hot sector like cybersecurity, it's probably trading at double the sales multiple that Darktrace is. Boohoo's another one. It's not a tech business, but it's obviously internet-enabled fast growth. Their equivalent in America is a company called Revolve, which is exactly the same business model. Instagram-led marketing, fast fashion, quick turnarounds, cheap clothes, exactly the same business model. Trades on 3-4 times the multiple that Boohoo does. That's just strange. And Boohoo's growing even in the US, Boohoo's growing at twice the speed that Revolve is. Look at Zalando, which is a German online fashion company, that's trading at 80 times earnings. Boohoo's trading at 20. So I think you can end up with situations in the UK where, a depressed area of the market or, a negative reaction can really have an impact, and then no one's left holding it, and you end up with a very, very compressed valuation, which is good for us as investors, as long as we can get a return to the norm or a reflection. And that sometimes happens through acquisitions, which we're seeing a lot of at the moment, where we're having every US company under the sun from every industry buying UK companies, across the board. So that's clearly a sign that there are pockets of undervalued. What do you think about that, Sam?
I agree. I do think the market generally is quite cheap. I think if you look at UK stocks compared to their peers, it is a lot cheaper. I think it's quite strange considering, a lot of it probably goes back to interest rates, and they're pretty much the same here as they are in the US. There's no reason why I think more people follow the US and pay attention, so that is why. But I mean, when we're doing, you can hear it on the show every week. When we're doing the UK businesses compared to when we do the US businesses, there is clearly a big difference. And for example, there's some UK businesses where they're quality businesses, and then we'll get to the valuation, it'll be like 30, 40 times earnings, and me and John will just be like, bloody hell, I'm not paying that. And then you get to the US bit, and it's 30, 40 times sales, and it's like, well, actually, it's fairly cheap. If they can, an example is actually, and it's a company we're going to talk about later, but Team 17, we've covered that a couple of times, and the growth rate's pretty good. I think it grows about 20% a year. Last time we looked at it, it was somewhere between 30 and 40 times. I can't remember. If you think they can continue growing at 20% a year, it's probably quite cheap. And if it was in the US, I don't think it would be trading at 30 or 40 times earnings. I think you would be looking at a multiple of sales instead, really. But because it's in the UK, it's just not followed that much. And there's other ones as well. Again, it's another business we're going to talk about later, but Games Workshop, I think it's a fantastic business. If you look at the growth they've delivered in the last 10 years, it really is unbelievable what they've done with that business. And then you look at it, and it's at the minute, it's about 30 times earnings. And again, that seems extremely cheap. And you mentioned Boohoo. We've seen the same thing with ASOS when we looked at it on the show. I know ASOS has also had the CEO just leave, but I mean, ASOS and Boohoo, they're pretty similar businesses. I think if you decided you want exposure to that sector, if you had a basket of the two of them at 20 times earnings, I think that'd be, I think they could both do pretty well. And I just think, again, I mean, I had it on the last interview where I was talking to the sloth investor, and I was talking to him about Airtel Africa. And again, it's a similar things like when me and John have covered it, where it's like, if that business is listed in the US, because it's a bit odd that they chose to list in the UK in the first place, but if they'd chosen to list in the US and they've got themselves on the NASDAQ or something, there's no way it's at 12 times earnings. There's absolutely no way. 12 times sales.
What does Jumia trade on?
Jumia's, it's definitely multiple of sales. I've not looked at it for a year. From memory, I think 30 or 40. And Jumia, when we actually covered it on the show 6 months ago, and Jumia, the growth rate was something like 10%. It was really poor. Part of the reason was that they used to do first party selling, where they were actually responsible for the logistics and the delivery themselves. And they've sort of transitioned out of that to more third party selling. So what's happening is the third party is getting bigger whilst the first party is shrinking. So you're getting this artificially low growth rate because the growth of the third party is making up for the decline of the first party. But even if you just take out the decline of the first party, the growth rate is still only 20% a year. And for a company that's that expensive, it just and it does have it doesn't have the best track record either, and it's growing from a very low base as well. It's extremely expensive. So yeah, I don't know. I think with the UK, when I certainly look at businesses, I think quality businesses are harder to find, but they are definitely there. And when you do find them, you generally get them at a much better valuation than you would in the US. So I almost feel as if the reward for finding them in the UK is probably a lot higher. That's my view.
Yeah, no, I'd probably agree with you there. I guess you've just got to kind of caveat it with, there's no point buying a business on 20 times earnings if you know that it's the exit multiple you're going to get is 20 times earnings.
Well, if you
as
think
well.
the earnings can grow, I suppose
Of
that's
course,
how.
of course.
But yeah,
Yeah,
I think you shouldn't be looking at it and saying, well, this is 10 times earnings here and 100 in the US. So I'm just going to sit there and I'm just going to wait for you shouldn't be waiting for a multiple revaluation. And I think if you do get a multiple revaluation, it's more likely to be the US multiple coming down rather than the UK going up. But yeah, I guess it's more you get a much higher margin of safety, don't you, with the UK ones? Yeah. Because if you get a business like Team 17, if that can grow at 20% a year and you're only paying 30 times earnings, even if it stays at 30 times earnings, or if that business grows at 30% a year, you would expect the stock over the long term to grow by about 20% a year in line with the business, assuming the multiple stays the same. But so how do you think about allocation and position sizing?
Yeah, good question. So I've got a kind of, I can give you my numbers in the sort of portfolios that I have. So in my personal portfolio, I have 27 stocks, and then in a family portfolio, which is a bit of a bigger portfolio, I've got 50 names. So I personally am quite, as I said before, a risk-adjusted return sort of enthusiast. So my largest position is 8% in the personal portfolio. I think the family one's about 4 or 5%. So I'm very pro diversification for a few reasons. Firstly, there's a lot of research that's been done, and you might have heard it if you follow Bailey Gifford. They've got a professor there whose last name is Bessembinder. I think his first name's Heinrich or something like that. And so, his theory is that, over a long period of time, the majority of stock market returns come from a very specific number of stocks. So if you're not owning, a large tail of stocks or names, it's quite easy to miss out, a good company that goes on to generate, some exponential returns. And that's why I was talking a bit about that insurance policy of, liking to have a couple of those names, like your Shopify's, your Teslas, for instance, if you wanted to. I don't think that's a problem as long as they're kind of, that position is not too big when you initiate it. There's another piece, obviously, in diversification, and I see a lot of people coming out in favor of owning a very, very concentrated 10 stock, 15 stock portfolio. And I guess this is because there've been some studies in the past where they look at risk adjusted returns and how much you're kind of reducing your risk for each stock that you add. And so people usually say that I think after 15 stocks, you're not really decreasing your risk exponentially for each name as you were with the first 15. But actually, if you look into a lot of those studies, what they were using was a random orientation of picking a stock. So they'd roll a dice and choose the stock that the dice landed on. They take a list of S&P 500 stocks and completely randomly select 15 names, 20 names, and see how they perform and the risk, in relation to the performance there. So kind of what I'm trying to say with that piece is that's all based on a random dice roll. When you look at most people's concentrated portfolios who might have 15 names that think that they're diversified, they're all in similar industries. There might be 5 tech stocks, similar geographies, all that sorts of stuff. So I think if you're going to do that kind of 15 stock highly concentrated portfolio, you've got to be careful that you're kind of not having a bias one way or another to kind of over allocate to something specific. And really then you're kind of missing the point of diversification and how that kind of statistical study of diversification came about. So I think looking at it that way, that's why I'm quite comfortable over allocating, you would say, and carrying quite a few names. Yeah, that's just my style, really.
My portfolio is actually about 15 stocks, I think.
What do you think about the diversification theory there then?
I agree. So I mean, there's good arguments on both sides. I mean, the one thing that really resonated with me was when I interviewed Adam Mead a while ago now. I mean, he just said, for example, because he only has like 7 stocks in his portfolio, or 6, I can't remember the number. And I asked him about that, and like he just said something along the lines of like, well, how much money do I want to put into my 8th best idea? And that did stick with me a lot. So at the minute, I've got 15 stocks in my portfolio, but I mean, the top positions, Etsy's about 20%, Airtel Africa's 15%, and Mercado Libre is 10%. So the top 3 are making up 45% of the portfolio. I've got a good few, I've probably got about 3 stocks. So I've got Ibstock, Money Supermarket, and my mind's gone blank on the other one. But there's 3 stocks in the portfolio where I'd say they're probably actually under review. And I'd say under review, they could stay in the portfolio for another few years. I'm pretty slow doing stuff like that. But there's 3 in the portfolio where, like, realistically, in the next sort of 6 to 12 months, I could sell those to add to another position, because I'm not sure, but I will spend a long time making my mind up. I mean, we covered Ibstock on the show 2 months ago and it was under review then. I expect when the full year results come out, it's still going to be under review. So they do get a long time to actually redeem themselves. But I think with running a concentrated portfolio, I think if you do it right, you will obviously get better results.
Yeah.
If you do it right. And it's really difficult. I mean, if it turns out that Airtel Africa is a fraud, that's 15% of my portfolio gone. I need to have a very good year just to make that up. So it is higher risk, but equally it's easier to follow the businesses more closely. So I guess as long as you are someone that puts the time in and does the work, it is less likely in a way, because it is much easier to follow 15 businesses than say 50. I mean, if you've got 50 in your portfolio, there's no way you can track them all. You've just got to accept that. And I guess they're all going to be different sizes, but I think it depends what you're comfortable with as well. I mean, what I found was, I did want to keep, when I earlier on, I wanted to keep increasing the number of stocks, because, people talk about like 2025 being like that magic number. And I wanted to try and get to that. And then what I found was, once I was getting over 15, it was like, I just found that there was always a few businesses in there where it's like, well, I don't really like these as much as my other businesses. So why do I actually own them? For example, like until fairly recently, I had Auto Trader in there, and Auto Trader is a really, really good business. I do really like it, but it's not as good as Rightmove. So I just found myself thinking, well, why don't I just own more Rightmove? So that's what I did. I just sold it and I just doubled the Rightmove position. So it's riskier, but as long as you put the work in and you accept the risk and you're comfortable with it, because I could have a 50% down here and it wouldn't bother me. I wouldn't need to access it for the cash. I'm 26 years old. I can, I can ride it out. And as long as I believe in the portfolio, I can ride that out. And I know, because I've been through, I've had stocks down 80%. I mean, I bought cryptocurrencies and I've seen drop 99%. So I can deal with a 50%. I know I can deal with a 50% drop in my portfolio. But if you're someone that you cannot run a concentrated portfolio. And if you're not sure whether you can or not, I'd say don't make it too concentrated, because when you find out, it could be quite painful. So those are my thoughts on it.
Yeah, no, I agree totally. Rightmove's a fantastic business. I think you did the right thing with your Auto Trader position. But I guess just to kind of clarify there, my 2 pieces off of 2 very different portfolios, which we can kind of go on to a bit later. But that kind of family one is, my objective is a little bit different to my personal one, being, it's mainly kind of the protection of capital, steady growth, all that sort of stuff. So, it's something that you potentially sacrifice a couple percentage points of gain just because you've got to kind of be, within the realms of that kind of goal there. And I guess on the 50 name side of things, I think some of them you obviously sort of spend more time on than others. For the super big caps in America, they don't take too much time up to read Microsoft's earnings, and you get a very kind of quick reaction from a lot of people reading the market. So, prefer to kind of stick to researching and like looking at the small to medium caps in the portfolio too.
I do agree with that. Actually, I think you have hit on something there. Like, for example, I don't actually own Unilever. John's got it in his portfolio, but I'd say if I did own Unilever, I would be completely comfortable not looking at that business for an entire year. I'd be absolutely fine with it. And then I'd probably just check the full year results every year. I think that's probably all I need. But Unilever's just not really, I know people are talking about inflation concerns and whatever else at the minute, but for me, Unilever's not a business that I need to be checking quarterly. Whereas, for example, an Etsy where I've got 20% in it and it needs to deliver on the growth, I do need to be checked. If I leave that for a year, that could be quite dangerous if I'm wrong. Whereas with Unilever, I think you can be wrong and it's probably not that dangerous.
No, exactly. You can go to the store and eat the ice cream as well. You know it's not fraud, right?
Yeah, exactly. So how much time do you spend a month on investing in your portfolio? And that would include the time you spend with your newsletter and all that.
Yeah, quite. I'd probably say an inordinate amount of time, but not to scare anyone. But yeah, probably something like 90 hours a month. 2 to 3 hours a day. But that's I could get by probably with half an hour a day. But this is my hobby. It's my passion. It's something I take a lot of pleasure in. So I love reading about the markets day in, day out. So it's kind of part and parcel of why I do what I do. But yeah, I've obviously got a full-time job that kind of restricts that somewhat. So yeah, it's roughly 2 to 3 hours, something like that.
Okay. I'd say I'm probably 10 to 15 hours a week. So I don't know what, I mean, that must average to similar. It's just over 2 hours a day, I think. But it does fluctuate depending on whether the book I'm reading at any given time happens to be an investing book or not. So that is the end of the general questions, more about your underlying philosophy. What we'd normally do at this point is we go on to the questions about your portfolio. However, we've been going for 90 minutes and you're the first portfolio we've done on the show where there's a good number of UK listed stocks on it. So I do actually really want to go to town on your portfolio. So what I would suggest is actually just ending this here and doing 2 episodes and just doing just catching this up next week or whenever, and just doing the portfolio questions as a separate episode, if you're happy with that, because otherwise we'd have to rush.
Very happy with that.
Because I am really actually enjoying the conversation and I don't want to have to speed it up. So that's what we're going to do. We're going to do the portfolio questions in a separate episode. So that's the end of this episode. So if anyone wants to learn more about you whilst they wait for the part 2, where can they go?
Yeah, head to www.thetwentiestrader.com or you can follow me on Twitter at Twenties Trader. Yeah, I think that's probably the 2 best places you can find me, and then you can kind of peel off onto any other channels from the website. So look forward to seeing you there.
Thank you very much for coming on the show, and I'll obviously be talking to you again very soon.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.